Hello and welcome to Portfolio Matters, week 176. Merry Christmas. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Thank you, Richard. First of all, some housekeeping. So this is going to be the last regular Portfolio Matters of the year, but I will aim to get one out before the end of the year, depending on our busy schedules over the Christmas period. The news. Well, it's been political turmoil all around the world. So in France, the government has fallen after Michel Barnier failed to get his budget approved by the RN, the Rally National, the Marine Le Pen's right-wing party. We await to see what happens. Macron needs to appoint a new prime minister. It doesn't seem like political stability will return to France anytime soon. In South Korea, we had an absolutely extraordinary attempt at what seems like a coup by the president, which lasted all of about 6 hours. You will see that the South Korean stock market has not taken the news well. Again, instability reigns in South Korea. In Syria, over the weekend, we had rebels, jihadi rebels, toppling the Assad regime. And again, instability reigns. There will be a coalition of jihadi forces attempting to run the country. In the US, Donald Trump has announced that he intends to impose 25% tariffs on imports from Mexico and Canada on day one of his presidency, and a further 10% tariffs on Chinese imports. Is that a negotiating tactic? US has announced more sanctions on Iran that sent oil briefly, and also OPEC announced it would delay its output hike of 2.2 million barrels from January to April, and it would now raise production over 18 months rather than 12 months, slowing the rate at which it would add extra barrels to the market. Now, currently there's a lot of cheating going on in OPEC, so the FT estimate that the UAE is currently pumping 1 million barrels above its quota, Iraq by 350,000, and Kazakhstan by between 50 and 100,000 barrels a day. So that is the reason that Saudi is getting fed up and wants to increase its own production. Elsewhere, Bitcoin hit 100,000 briefly. It's down since then. And UK immigration was revised up to 900,000 for the year ending in June 2023, above the previous already extraordinary estimate of 740,000. It's now estimated to have fallen to still an astonishing 730,000 in the year to June 2024. Some charts related to the news. Well, after November non-farm payrolls came out close to expectations, the market is pricing in a near 90% chance that the Fed will cut this week. This is the Korean stock market. Not so good. Not doing well. It was doing poorly before the coup attempt. It's only got worse, and that is despite government attempts to buy equities to prop it up. The political turmoil in France has not really affected the bond market, but it has affected the stock market, which is not doing well relative to Germany. Now, this is US imports of goods from Canada, China, and Mexico. Now, Donald Trump is threatening to impose 25% tariffs on Canada and Mexico and a further 10% on China. Is that a negotiating tactic? Let's see. And this is France. France is running budget deficits that are on a par with the US, but without the benefit of reserve currency. And it already has the highest tax to GDP ratio in the world. So massive deficits, already enormous taxes. The US, which is running massive deficits, has the fiscal space to increase taxes. France, I don't think it does. France is in real trouble. Donald Trump has been picking lots of weirdos, frankly, to try and run US departments, but Treasury Secretary pick looks sensible. And this is Bitcoin off to the races, touched 100,000, has come back slightly since. And that's led to a return of everything in crypto going through the moon. This is the crypto stock Pepe, which has had a green frog emblem, market cap 10 billion, Sainsbury's is 8 billion. You know, these are not small and there are loads of them. Fart coin, market cap of 200,000, turns over 25% of its market cap every day. There is literally a shit coin. Is losing 90% of your money that amusing? Total market cap of cryptocurrency is now 3.6 trillion. This is trivial, although, you know, it sounds it. Onto this week's economic data. Quick summary. Well, in the UK, private sector appears to be weakening, but this will be offset by an increase in public sector spending in the coming year. EU weakening again. US still remains strong, but slightly weakening. Actually, if you look at the nowcasts generally. China, weak. On to the UK, Richard.
Thank you, Keith. UK car sales were better than forecast, but nevertheless down 1.9% in October. And UK nationwide house prices increasing 1.2% in November, and UK house prices have started climbing again, haven't they, Keith?
Well, I'm amazed by this, given the rise in interest rates and the terrible housing affordability. But when you add 1.7 million to the population, you know, and you don't increase housing,
and assume maybe 3 people share a housing unit, that means you need to provide roughly 600,000 units over the last 2 years just to cover net immigration.
Last night, I was looking for second-year accommodation for my son at a London university, and it was astonishing how expensive it was.
Yeah, I mean, it is just there's total mismatch.
Yeah. You're talking about minimum of £300 a week, up to, you know, whatever you like.
Isn't it? Yeah. And if you're on the minimum wage,
the
new minimum wage, £300 a week, 15,000 a year. New minimum wage is around about 25,000 a year if you're a full-time worker, pre-tax. So virtually all your money goes on rent.
Well, the thing is, my son's friend is on a student loan, which is a maximum of £8,000 a year. And so, you know, if you're paying £300 a week in rent, it just doesn't work.
It all goes in rent, doesn't it?
Yeah.
Even if you're not paying rent during the holidays, which is only true for some holidays. The UK CBI distributive trades down at minus 18% in November, which is pretty poor.
Yeah, so retail sales in the UK have had a bad couple of years, actually. Retailers feeling pessimistic.
Yeah. UK car production down 15% in October, year on year, and UK Citigroup Economic Surprise Index at minus 36 this week, so pretty near the low of its range. Indeed, job postings index, very slightly up, but I would say that downtrend is still intact. And
yeah, but I was expecting after the budget for this to collapse, and it hasn't. Here,
UK net migration is beginning to fall, but is extraordinarily high and unsustainably high, simply from an infrastructure point of view.
yeah,
And as it says aside there, we have lost control of it.
yeah, absolutely.
That's a chart just showing the distribution.
Yeah, you see huge numbers of dependents, study dependent, work dependent. So these are students or workers come over and they bring their families.
Yeah, and okay, so the poor quality of UK statistics, which we've been talking about for a while now, particularly the employment statistics, but others as well, it seems to have had its inception when the UK Statistics Office moved out of London to Newport in South Wales, during which 90% of the existing staff left because they didn't want to live in Newport, South Wales.
Yeah.
Knowing Newport quite well, as I do, so what a disaster.
Yeah, it's one part of government sabotaging another. Basically, they make these cost-cutting decisions with no thought about the effect.
So not much news in the past couple of weeks. The economy has not collapsed after the budget, but I suspect we're going to see some very serious knock-on effects from the budget on the employment and particularly the hospitality and entertainment sectors.
Yeah.
Employers of large numbers of relatively low-paid individuals, and the UK economy is weak, and it's hard to see how we pull ourselves up out of this mess.
Yeah.
Is that the cheerful bit done now, Keith?
No, we've got lots of cheerful bits.
Oh, God, lots. Oh, great.
Okay, and actually some good news.
Monday morning cheer, sorry.
Well, yes. End of year cheer. Actually, we have some good news here. Thank you to our Discord member, Richard Wilk, for sending this. So let's look at Britain's net financial position. So, because it's amazingly good news. So when we talk about the government debt, we tend to concentrate on the current liabilities. So how many bonds it's issued. So what its current debt is. But in addition, it has non-current liabilities, which are mainly the public sector pension liabilities. One of the effects of rising interest rates has been to increase the discount rate on those liabilities, which reduces their net present value. So the current value of the public sector pension liabilities have fallen from 2.6 trillion to 1.4 trillion. That's an improvement of 1.2 trillion. And the overall effect on the government finances has been that net financial liabilities have improved by a massive 1.5 trillion, from 3.9 trillion to 2.4 trillion. So when you look at just the headline debt numbers, it seems that the UK public sector is becoming increasingly indebted. But when you look at its liabilities in total, the last couple of years have seen an absolutely enormous improvement in its total liabilities.
Is this an example of smoke and mirrors, though? Because what they've done is they've taken the future liability for pensions, public sector pensions are unfunded, so they're paid out of taxation.
Yeah.
And they've discounted them at a higher discount rate, but the actual cash outflow that will be required hasn't changed. And because it's unfunded, there's no pool of assets that's earning interest at 4%.
That's a good point, Richard.
So I think this is smoke and mirrors. I mean, unless someone watching corrects me, that is what I believe to be the case. So I think it looks very nice.
Okay, moving swiftly on. On to the EU. Okay, so CPI in the EU missed expectations. This is a flash estimate It was estimated plus 0.2 and it came in at minus 0.3. CPI, though, year on year, came in at 2.3 on target. So I don't really see how the monthly massively beating is compatible with the annual coming in on target. Core CPI came in at 2.7, slightly better than expectations, unchanged from October. Now, this is Goldman's estimates for the core services inflation adjusted for seasonality. And what they're showing is that core inflation actually is coming down month on month. Core services here, the dark blue line, looks month on month looks pretty flat, zero in November. So what they're saying is that Eurozone inflation absolutely is coming down, although the headline numbers don't yet reflect that. Retail sales in October missed expectations, coming at minus 0.5%. The year on year, they're 1.9%, slightly better than expectations. Construction PMIs just keep on getting worse than expectations, and that is a terrible number. Contrast with the UK, where construction PMI is strongly positive. Economic sentiment going nowhere. Consumer sentiment falling again. Industrial sentiment ticked up, remains terrible. Services sentiment weakening. 1 year inflation expectations sadly ticked up. Loans to companies were positive, but mildly so, better than the fall in September. Loans to households ticking up, but weak. Money supply positive. Unemployment rate at its lows and not ticking up in the EU as a whole. Citigroup Economic Surprise Index keeps getting worse, having briefly ticked up. It's negative again. Job postings, well, is there a seasonal effect here where you're looking for workers in shops for the Christmas period? Perhaps everything seems to have ticked up slightly, but I'd say that the general downward trend remains intact. In France, still falling. Robin Brooks is saying that although the headline US dollar number, which is down here, the white line, does not look like the euro is overvalued, when you look at its trade weighted average, the euro is at its highest level since the GFC, and he's saying the euro is overvalued and should fall.
That's a big overvaluation as well. That's something like 50%, 30%, even a 30% fall.
Yeah, absolutely. If Donald Trump imposes tariffs and cuts the eurozone's trade surplus, then you see a sharp fall in the euro. So EU summary, little change in the economic data. Bottom line, EU economy remains weak, but with low unemployment. There does seem to be disinflation in the Eurozone, although the headline numbers have slowed recently. We wait to see whether Donald Trump will follow through with his threat to raise tariffs. On to the US, Richard.
As Keith, non-farm payrolls were better, up to 27,000.
Yeah, now the reason that the markets have taken that number well, despite it being a beat, is that the market was expecting the October number to be revised very strongly up. So they're expecting the market to, because of the hurricane, etc., they're expecting the October number to be revised up to 100,000 and more. It wasn't.
US construction jobs falling.
Well, they remain positive. The growth rates.
Yes.
Yeah.
The establishment and household surveys are diverging again, with the non-farm payrolls continuing to rise, but the establishment employment level flattening out for the last 3 or 4 months.
So that's, sorry, the red line, Richard, is household survey, which shows last month They're saying 355,000 people lost their jobs. So once again, we've talked about this so many times over the last
Yeah.
couple of years. So, the model, the births and deaths model in the establishment survey keeps on estimating rising jobs, but the household survey says the opposite.
Yeah. And household survey reported a fall of 111,000 full-time jobs in November and 1.3 million full-time jobs in the year, with part-time jobs up by 600,000. So suggesting that the US employment market is not that strong.
Yeah.
Full-time job growth in the US has stalled.
Yep. Down 1.3 million from its peak. The grey line is non-farm payrolls. The red line is the household survey. And over the course of the last 18 months, you've had a huge divergence. The non-farm payrolls is saying you've had 3% growth in jobs in the US, whereas over the past 18 months, is it? 16 months, whereas the household survey is saying you had no growth. That is a huge divergence. Which one's right? Question.
Yeah. US average hourly earnings up 0.4% in November, which is an annualized rate of around about 5%, I would guess. Average hourly earnings year on year at around about 4% in November, slightly higher than expectations. And the US participation rate is, well, just very slightly down. Difficult from the graph to know where it's going at this point, isn't it, Keith?
Yeah.
It's sort of finished climbing from COVID. So,
yeah.
US weekly hours worked was up at 34.3. And US U6, the unemployment rate was at 7.8%. So there's a gently rising
There is. There. There's a gently rising trend, and it's been rising for quite a while now, actually.
Yeah. The US unemployment rate, 4.1%. And again, a very gently rising trend from about 2023. The median duration of unemployment is at 10.5 months, and that line looks like it's starting to rise, meaning it's harder for people who are made unemployed to find a new job. US JOLTS job openings, 7.7 million, but that is on a definitively downward trend. US JOLTS quits rate, again up in October, but on a definitively downward trend. And the JOLTS hire rate is also on a downward trend, quite a sharp downward trend, showing no signs of changing that. The layoffs and discharges rate remains very low indeed.
It does, yeah.
And the ADP employment change was 146,000. October's was revised down from 233,000, which is a big downwards revision. US challenger job cuts, pretty stable actually, 57,000 in November, but that chart isn't going anywhere at the moment. US PCE month on month, 0.2%, that's flat. Year on year, 2.3%. It's a very slight uptick. Core PCE month on month, 0.3%, again flat. Core PCE year on year, 2.7%, and fairly flat for the last few months.
Yeah. So people who are worried about inflation talk about inflation coming back. But when you look at the causes of the uptick in PCE inflation, essentially it is all portfolio management fees, which are a percentage of your portfolio. Stock market goes up, fees go up. So that feeds through to the inflation numbers, but actually is just a function of the stock market boom.
Interesting, isn't it? So US personal income, better than expectations, up 0.6% in October. US personal spending up 0.4% in October, and nothing remarkable there, I would say.
Agreed.
US existing home sales is slightly up on the month, but quite a low level in comparison to past years or so. US factory orders month on month, pretty much flat, in fact, and revised upwards in September. US construction spending month on month up 0.4%.
Yeah. Earlier in the year, when it kind of came down sharply, expecting that to be the turn, but it hasn't been.
The Chicago Fed National Activity Index down 0.4%, and that's a fairly negative-looking graph. ISM manufacturing PMIs 48, just really going nowhere for the last few months. So the ISM Manufacturers Price Paid Index, which is a good indicator of inflationary pressure over the last few years, is indicating that inflation basically should be under control, which it does appear to be. The ISM Services PMI is quite sharply down, but still above 50.
I was expecting that after Donald Trump was elected, you get this euphoria from business, and actually you got the opposite.
Yeah, that's very true. The Case-Shiller House Prices Index month on month down 0.3%, and year on year up 4.6%. US new home sales 610,000. US the Michigan Consumer Sentiment Index continuing to rise. Actually, over the last 2 years, it's been on an upward trend, and it's continuing that. The Current Conditions Survey sharply up.
Yeah,
that must be a Trump effect.
It must be. Yeah, must be. Politics.
Yeah, and the Michigan Future Expectations is down, but it's in this uptrend, this sort of uptrend from mid 2022.
But it's odd, isn't it? And so suddenly people are feeling good about where they are now and bad about the future.
Yeah, very peculiar. So the 1 year inflation expectations index is up slightly at 2.9%, but that trend is still intact. That downtrend is still intact. And 5 year inflation expectations at 3.1%, so the top end of the range actually for the last 10 years. US initial jobless claims 224,000 this week, which is okay.
Yeah, no evidence of rising trend really.
No, and continuing jobless claims 1.8 million, which is sort of higher than it has been previously over the previous decade, but there's no rising trend there. The Indeed jobs posting index, that downtrend looks like it's slowly leveling off.
Yep.
And LinkUp is reporting rapidly declining job openings in the US, which is slightly contradictory to what we're seeing on the Indeed.
Yeah, exactly. And this is an extraordinary chart, and it just doesn't appear to be verified by other data providers. We'll just have to wait and see.
I mean, the other thing, just nipping back to that chart, Keith, is the scale of charts that have these hugely truncated scales can be very misleading.
No, that's true. But what it's showing you is job openings, online job openings in the US, falling quite sharply.
Yeah. US small business hiring fell again in November.
Exactly. When you talk about non-farm payrolls, coming in strong.
Yeah.
Well, small businesses are the majority of the US job creation, and it's been very weak for a long time now.
So the Dallas Fed weekly economic GDP indicator estimate is at 1.8%. and the Atlanta now is at 3.3%.
Yeah, going in the opposite direction.
Quite high, actually, yeah.
Yeah.
And the New York Fed GDP now cast 1.9%, which is actually the same as last week.
Yeah, I of all of them, I like the New York Fed one the most because it's the most stable. When you look at the Atlanta Fed, it just flies all over the place,
It does,
depending on a
doesn't it?
few data points.
Yeah. All indicating, so St. Louis Fed is at 1.2%, which is down from last week, all indicating continuing growth in the US economy.
Yep.
The Citigroup Economic Surprise Index is at the top end of its range, just fallen back a little bit from last week.
Yep.
Trueflation, 2.85%.
Yeah, that's not great. Not great.
And the US budget deficit over 2 trillion in the past 12 months.
Shocking. Joe Biden. Yeah.
Did you see that he's been voted the worst president in living memory?
Really?
In a US poll. Yeah.
Yeah. Well, I see he's pardoned his son, which does not leave a good legacy. He was attacking Trump for, corruption, etc. And then he does that.
Indeed. Or at least, yes, exactly so. So US GDP growth forecast 2025, around about the high 2%, 2.6
Yes.
to 8%.
Very good. The UK would kill for that.
Real US durable goods orders, which is the red line at the bottom of this graph, has been stagnant since 2021. So what does the federal government spend money on? Entitlement spending, basically. So that's how if you're going to cut US government spending, you have to cut entitlement spending.
Yeah, and that is tough, and that is unpopular. So what's Elon going to do? Watch this space.
Well, what's sort of happening is that there's this huge disparity between the wealthiest American citizens and the rest. And this is a process of redistribution by which you say, well, we'll allow the wealthy people to keep their money and we'll tax the middle income people so that their money can be redistributed to the poorest. But in actual fact, the problem lies at the top 10% or so. And what they should do if they want to do this is they should massively increase taxation on the top 10% and to get them to redistribute their wealth, which is the purpose of this exercise, redistribute their wealth. So they've got it slightly. So basically what they're doing is they're maintaining the wealth of the top 10%, they're punishing the middle group and they're funding the bottom group.
Yeah, I don't disagree with you, Richard, but they've voted in a billionaire. So, the chance of him raising taxes on the top 10% is, pretty much zero. And also, the US is the most dynamic economy in the world.
Yeah.
And I think one of the reasons for that is that there's just a huge economic incentive set into the US system. So if you succeed, you do incredibly well. And if you fail, you end up on the streets with very little safety net. And the US likes it that way. They like the strong contrast between success and failure, whereas we in Europe don't like that. And we're doing our best to reduce the difference between wealth and poverty. And actually, there's not enough space to do it this time, but next time we'll be talking about how UK disability benefits have gone through the roof. And that is a function of the disability system, the benefit system, not of actually the health of the population.
You make very good points, Keith. I don't disagree with any of them. It's quite a complex problem, isn't it? Oh, it's a very complex problem. Here is what would happen. If all the 11 million illegal immigrants who've come in, I guess, over the last 4 years under Biden, very roughly speaking, were deported, this is where the sectors in which the most damage would be done.
Yeah.
And they are, of course, a big employing the big employing sectors.
Yeah. So there would be big consequences on, just the number of people, work available, and therefore inflation.
And the federal government's workforce has stayed steady over the last 60 years, but local government has particularly increased like fivefold. And
Yeah.
state government has increased, actually state government in terms of percentage terms, it looks like it's increased about the same, about fivefold. So massive increases in local and state, fairly steady federal government.
Yeah. So again,
Elon is going to have to, well,
and
as you say, Keith, he's going to have to attack benefits, as we would call them, entitlements, and local government. Growth in administrative staff, principals, teachers, and students in US public schools. I mean, to be fair, the US population has gone up, so you would expect there to have to be more
yeah.
teachers.
Well, but the thing is, Rich, when you look at this, local government, this is the education system in the US is all paid for mainly by the states and mainly through property taxes.
Yeah.
But, it's been rising.
Yeah.
And it's not due to teachers.
It's admin stuff.
It's admin staff. So there's fat to cut, I would say.
How does Elon cut local government though? I don't know.
Can't.
Does he have any? No, well, they could, but they'd have to introduce legislation to do it, wouldn't they? Federal legislation. US productivity growth has massively outstripped that of the rest of the world. And that is true.
Yeah. Well, this is why the US is wealthier than the rest of us.
Rachel Reeves, it has to be said, though, she's doing her best.
Thank you, Richard. Yes, that is a positive note of optimism for the year end.
Credit where it's due. So, summary. Non-farm payrolls came in hot, but we don't necessarily believe them.
Yep.
So wage growth was stable at 4%, which is a little bit probably on the high side as far as the Fed's concerned, but it's not too bad. Jolts openings bounced, continued, but all of those jolts are on quite a significant downward trend. PCE inflation, 2.3%, was due to portfolio management fees. Good old financial services sector. And ISM services showed a surprisingly sharp fall in November. Bottom line is the US economy is growing, is resilient, and despite everything, all the adverse things people say about it, it's better than the rest of us.
Yeah, absolutely. It's just ticks along strongly. Let's see what Trump does. On to China. Well, numbers out this morning confirm the Chinese economy ain't doing so well. So I like the inflation numbers because they are hopefully not manipulated like the other activity data. And they're showing that China is slipping into deflation, which means there's an excess of supply over demand. So a weak economy. And it fell by an astonishing 0.6% in November, below expectations, below October. And that brought the annual inflation to 0.2%, down on October, below expectations. Turning to the Caixin, that's the private sector manufacturing PMI. See, they're saying in November that activity ticked up. Do we believe them? The services PMI actually fell slightly, leading to the composite up slightly and in expansion territory. But frankly, the inflation numbers suggest the Chinese economy is not doing well. Industrial profits year on year, minus 4.3%, not good. And the bond market is telling you the Chinese economy is weak. So Chinese 30-year bond yields are below those of Japan. So Chinese summary, not much data. Caixin PMIs, anyway, Chinese economy is struggling in the aftermath of its property bubble. I can't see it getting much better, frankly. On to one chart. Now, this is the chart showing in orange the future 10-year return of the S&P 500. The grey line is the Shiller cyclically adjusted PE ratio. And what you see is that there is a good correlation between the P ratio on the S&P 500 at the start of the period and the returns over the subsequent 10 years. And right now, the Cape-Shiller P ratio is very elevated, and it is suggesting that returns over the next 10 years of the S&P 500 should be very poor. And the fact that the correlation has broken down a bit, to me, suggests that the equity market is living on borrowed time. We are in a bubble.
If you look at that graph, there are times, aren't there, like 1988, for example, where for some time the correlation has remained damaged, and then it has fallen back into line.
Yeah, exactly.
So
that's what I expect to happen.
Where we are now.
Yeah, exactly, Richard. And quiz of the week.
Oh,
are you ready for this, Richard?
I'm ready.
Who's this? Why did he apologize?
Source BBC.
Yeah.
Is it anything to do with the BBC?
No. Okay. I'll put you out of your misery. It's the CEO of the Japanese bank Nomura. Okay, so he had to give a tearful apology to everyone this week. And he took a 30% pay cut after one of the employees in the Nomura wealth management division went to see a client in the Hiroshima district. He then drugged them, stole their money, and set fire to the house. So, when Rachel Reeves is talking about, unleashing the animal spirits and of London bankers and how they've been overregulated since the GFC, well, bankers their instincts are not something you necessarily want to unleash too far.
Feral.
Yes, exactly. Some clarification. Last week we were talking about temporary health services, and we showed you this chart. And historically, temporary help services have been a very good indicator of a slowing economy and a predictor of a coming recession. Temporary help services slow, recession follows soon afterwards. Not this time. Now, regular viewer Mr. C. Peckham got in touch, and we also showed you this chart last week, which is illegal immigrants, and he said that the failure of temporary help services to predict recession could well be caused by this surge in immigration. So companies, instead of outsourcing menial jobs to temporary workers, they've outsourced them to cheap immigrants. So if immigration returns to a normal level, you might expect this to start working again next cycle. But this cycle, it ain't. Okay, now this is really important if you're invested in gilts of any kind, long duration gilts of any kind. This has massive implications and is one of the most important segments we've ever done, particularly for me. Okay, so this was from Chris Giles in the FT, and this chart shows the inflation break-evens backed out of swaps for the different bond markets. So far left, US, showing inflation expectations remain pretty subdued at about, 2.3%. So in the UK, 20-year, 10-year forwards, you're talking about 3%. So the pricing in UK inflation, which is 1% higher than in France or Germany and much higher than in the US. Okay, now, historically, there's a good reason for that. Because the UK RPI, everyone else uses CPI, UK uses RPI in the bond market. And so when you are hedging your inflation, you get RPI, and RPI is about 1% higher than CPI. So hence, UK inflation, as discounted by the financial markets, rationally is expected to be 1% higher than elsewhere simply because the UK financial markets index-linked gilts use RPI. But from 2030, the index-linked gilts will not be using RPI. They'll be using CPIH. Now, if we go back to this chart, this table, you'll see that since over the last, whichever period you measure it, CPIH is much lower than RPI. Since 1989, it's about 0.8% per annum below RPI. In 2010, it's a massive 1.1%, sorry, 1.3%, sorry, below RPI. 2015, 1.4%. More recent period, frankly, a shocking 1.9%. So whatever period you measure it over, CPIH much lower than RPI. And that has huge implications for the relative returns of index-linked gilts versus conventional gilts. The bottom line is, if you're looking at an index-linked gilt with a 40-year duration, from 2030, i.e. in 5 years' time, you're going to get around 1% per annum less than the market is expecting. So sum that up. That's a 35% drop in the return. And that has to be reflected in the price now. But it's not. And so this is the chart of UK inflation expectations backed out of the bond market. And his point was, in 2030, there's a 0.4% drop in inflation expectations, not 1%. So he's saying that 60% of the drop has not yet been discounted by bond markets. Now, he had 4 possible explanations for the pricing that this mismatch. 1, the market does not believe the change to CPIH will happen. Well, it will happen. 2, the real yield on long-term index-linked gilts is artificially depressed by demand from pension funds. Well, that's plausible, but we know that defined benefit schemes are increasingly a less important part of the UK pension scheme mix. Financial markets do not believe the Bank of England will deliver its market mandate, and they believe that actual inflation, as measured by CPIH, will average 3%. Well, I'm not sure that explanation works, because if you go up here, you would have to believe that CPI inflation is going to rise in the long term as measured by CPIH, because currently you're getting RPI, so you'd then have to expect there's going to be a step change upwards in UK inflation, underlying inflation from 2030. That doesn't make sense. Finally, the market is wrong, and I think it's very likely the market is wrong, and that means that index-linked gilts are massively overvalued relative to traditional gilts because of the change in CPIH. So this is not an argument about the future path of interest rates in the UK or inflation. It's only about the technical change from RPI to CPIH. So if we work this through, you'll see that this is, if you hold index-linked gilts, you could be in deep trouble. So if the top table, this is where we are now. Conventional and index-linked gilts should have very similar returns. And if we look at, say, the 30-year, about 4.88%, the RPI assumption is 3.3%. Yeah. So if you hold an index-linked gilt, you are going to get 3.3% from the indexation, and you get the remainder of the return from capital appreciation to get you to 4.8%. Your real yield is 1.5%. Now, after the change to CPIH, the indexation only gives you 2.2%. So currently you would get capital appreciation of 1.5%. So your total yield is 3.7%, well below the yield on a conventional gilt. And that means in order to match the yield on the conventional gilt, the capital appreciation, annual capital appreciation on your index-linked gilt needs to rise from 1.5% to 2.6%. Do you see that? Richard, do you see that?
Yep, get that, Keith.
So that means if you've got a gilt that holds, let's say, has 35 years maturity after 2030, then it needs to fall by at least 30%. So this chart shows that effect. If yields on conventional gilts remain at 4.8%, then in order for index-linked gilts to match that, capital appreciation must rise from 1.5 to 2.6%, or 1.1% per annum. On a 30-year, that employs the price of the index-linked gilt must fall by 28%. Now, if you're looking at conventionals, so we've assumed in that previous example that yields remain at 4.8%. But what if the real yield remains at 1.5%? So currently on an index-linked gilt, you get a indexation of 3.3%, capital appreciation of 1.5%. So your real yield is 1.5%. Now, in future, after the change to CPIH, the indexation will fall to 2.2%. If the real yield remained 1.5%, then the yield on conventional gilts should fall towards 3.7%. Now, if that were to happen, the price of conventional gilts would have to rise by 40% so the yield fell from 4.8 to 3.7%. That's if for a 30-year conventional gilt for the 30 years after 2030, when the change to CPIH happens. So, caveat, this is all my analysis. This is so, this, once again, this is not investment advice. This is what I think is going to happen. And if I'm wrong, please get in touch. But what I think is there's going to be huge moves. The implications of this are absolutely enormous, because for long-dated bonds, when you're talking about reducing the yield on the indexation by roughly 1% per annum, then that means index-linked gilts will yield 30% less if you have a 30-year bond after 2030. And that needs to be reflected in the price of index-linked gilts, and that in turn has huge implications for the price of conventional gilts. And so this is not at all an argument about the outlook for inflation or inflation expectations in the UK. This is just about the impact on the gilts market of the technical change, which has not yet been fully discounted. Now, what I think is likely to happen is not that conventional gilts will rise by 30% and index-linked gilts will fall by 30%. I think they'll both move towards each other. So bottom line is the long end of the gilt curve is currently pricing 4.8% total return. And that assumes UK inflation will average 3% plus in the long term. But CPIH will materially undershoot this, unlike RPI. So conventional gilt yields are likely too high because the premium above inflation rises substantially at the long end if after the move to CPIH. So real yields currently, if you buy a conventional gilt, your real yield currently is about 1.5%, but after the move to CPIH, it moves to, let's say, 2.6%. Index-linked gilts yields are likely too low because they're assuming you get 3.3% from RPI when actually you're likely to get much less than that from CPIH. So if you hold long-dated index-linked gilts, you need to get out. Simple as that. So, and you need to buy the conventional. So I have done that. I've taken enormous losses on my index-linked bonds, but I have switched into the conventional. Richard, any thoughts?
No, so interesting, Keith. Did you? I mean, it's one of these contrivances that you get sometimes in the financial markets, isn't it? And
Yeah.
it's not my area of expertise, but it's very interesting analysis. Thanks.
Yeah, no, so very painful for me. I've bought index-linked gilts for the duration, and actually, the moment I read this from Chris Giles, I immediately recognized that this had huge implications.
Yeah.
And we'll go through what I've done in my portfolio section later. So now we're going to do a section on carbon capture. And because I've done a chemistry degree, I'm slightly nerdily interested in how this works. So I thought it worked by using calcium oxide, i.e. Lime water that you might have done in the O-level chemistry back in the day, but it doesn't. It uses amines such as this, and the reaction is that your CO2 reacts to the amine group and binds to it, and you can reverse that process by heating the whole mixture up. So you run your carbon dioxide rich flue gases through an amine solution. You then heat the amine solution to release the CO2 later. Now, on to UK carbon capture plans. Richard.
Thank you, Keith. Otherwise known as colossal concentrated stupidity for those of you who can't read. So, the Labour government, a lot of this is Ed Miliband, isn't it?
Well, actually, to be fair, the Conservatives,
Did they?
yeah, had these plans beforehand. He's just expanded them.
The Labour government has pledged £22 billion for UK carbon capture and storage facilities over a period of time. And you can see there's 7 locations that are earmarked there for these facilities.
Yeah.
And, so what's the total? It's 8, 12, 16, 21, about 33 million tonnes total of capture, presumably annually from these locations.
Yeah.
So we will start to employ these technologies initially in Teesside and Merseyside.
Yep.
Capturing them presumably from gas-fired power stations. That's the aim.
Yeah, well, loads of stuff, actually.
Yes. And there are currently none of these plants in the UK. Conservative government announced plans for the 2 that we've just mentioned. They'll capture it from industrial sites, including hydrogen plants, waste incinerators, gas-fired power stations, and cement works. Cement produces an awful lot of carbon dioxide. It will be transported to offshore storage sites such as depleted oil and gas fields once it's been captured. And obviously then it will be sunk into those depleted oil and gas fields where there should be space for the stuff to sort of settle down. It'll be there forever. And the plans will create 4,000 jobs and possibly up to 50,000 roles, presumably in manufacturing the stuff and supporting it.
Yeah.
And we can produce CCS to produce so-called blue hydrogen, which is hydrogen produced from natural gas as opposed to from wind turbines and solar panels. Blue hydrogen is made by heating methane, CH4, with a catalyst, and you get and presence of oxygen, and you get carbon monoxide and carbon dioxide as byproducts, and the H's go off from the methane and become blue hydrogen. So the idea is you capture the carbon monoxide. Dioxide.
Hugely energy inefficient process.
Exactly, yeah. So there we are. Well, this is a very pretty picture that summarises, I think, what we've just gone through. Is there anything to add on this, Keith?
No, You're going to go to pump all the carbon dioxide into um, old oil and gas wells, but look at the size of these pipelines: 145 kilometers, 103 kilometers.
So how much will we actually capture? Well, that chart that you showed at the start was about 33 million tons was the aim, wasn't it? Yeah. So UK is aiming to develop 2 industrial clusters and 2 later, Teesside and Merseyside, to capture 20 to 30 million tons by 2030. That's 5 years.
Yeah.
And obviously supporting the development of blue hydrogen with the aim of producing 10 gigawatts of blue hydrogen. So one of the problems we have discussed previously with hydrogen, I don't know, is that it causes embrittlement of transportation pipes, and you can't distribute hydrogen through conventional gas pipes.
Yeah.
Methane pipes.
I don't think anyone's, they're not thinking about that far ahead, Richard. And also, as will become clear, I think this is all pie in the sky.
I think we should, actually, I disagree, Keith. I think we've got a lot of hydrogen here, and one of the biggest polluters are aeroplanes.
Yeah.
And we know that hydrogen is highly effective for airships, airship technology.
Yes, absolutely.
So we
Bring
can
back the Hindenburg.
The UK can be the leader of the new Hindenburg class of hydrogen airship.
You should write to Ed Miliband as a solution to our transportation needs, Richard.
Oh, how much will it cost?
Yeah.
So how much will all of this cost? So UK government suggests 21.7 billion over 25 years, only 870 million pounds a year. And obviously it can attract 8.5 billion of private sector funding via contract for differences, which will be passed on to consumers via their energy bills.
Yes.
Makes sense.
So we end up paying for all this.
Who thinks this is a good idea? Well, the TUC, because it creates lots of jobs.
Yeah.
The UK government, because they don't understand what they're talking about. And I don't mean that carbon capture is wrong. I just mean that putting together something this quickly, this fast, isn't going to work. And it gives excellent green virtue signalling points. But the problem with it is it's completely unattainable, isn't it? So who thinks this is a bad idea? Friends of the Earth, in the United States, where carbon capture is most established, 80% of projects fail due to technical issues, over expenditure, and a lack of financial investment returns. The UK has already, let's say, committed nearly 500 million on these projects since 2010. And both of the projects that were part of this development have failed to get off the ground. The technology is not proven, and there are no working examples of CCS on a gas burning power station anywhere in the world. And nor are there examples of carbon capture projects achieving a 90%, 95% capture rate, which presumably is what's been assumed in the projects that are operating globally, 73% of the carbon captured is used for EOR.
Enhanced oil recovery.
Oh, right. Oh, that's okay, isn't it? You just pump it back into the ground and the oil comes out.
Yeah. Isn't that great? It's like total hypocrisy.
So Friends of the Earth don't think it's going to work. That's not a good indicator, is it?
No.
What is the environmental effect of these amines? That's what I want to know.
Yeah, we don't think about that either, Richard.
So the Institute for Energy Economics and Financial Analysis suggests that CCS does not reduce the upstream emissions of methane, which occurred before the gas reaches the site. So liquefied natural gas imported on fossil fuel powered ships are actually presumably liquefied by fossil fuel generated energy at the point where it's liquefied.
Yeah.
And it's therefore myopic carbon accounting because it's only looking at one part of the chain and not the whole chain.
Yeah.
It has not been demonstrated at a commercial scale to claim specifications and no pilot plant, and consumers will be left paying higher bills for emissions impact uncertain, subject to ongoing debate. What is the carbon cost of building these plants and running them?
Yeah, again, nobody asked those questions, Richard. They're vastly more than the amount of carbon they're going to capture.
Why don't we just build some bloody nuclear plants and be done with it?
Well, I totally agree.
Shut down the gas-fired. We can use electricity for cement production, electricity for steel production, electricity for fertilizer production, all from nuclear power. We don't need any of this nonsense at all.
Exactly.
Does Ed Miliband listen to our podcast?
Does anyone listen to our podcast? Good question.
So, our view is the UK government does not understand. Oh, there's some more, sorry. The difference between wealth creation and wealth transfer. I'll say that again. So we think the UK government doesn't understand the difference between wealth creation and wealth transfer. So in wealth transfer, the government pays for a private service that leaves no infrastructure of economic use, like paying people to dig holes and fill them in again, which is what sort of CCS is really, isn't it?
Yeah.
And wealth creation, government pays for the creation of infrastructure of lasting economic value, dig holes and put something useful in them, like gas pipelines. So,
yes,
I mean, in essence, the UK government and to be fair, pretty much every government's energy policy for the last 50 years has been a disaster. And the solution, to my mind, has always been and currently is nuclear power. And we do away with fossil fuels entirely.
Well, I totally agree with you, Richard. So,
what's the alternative, Keith?
Well, we have our own alternative, which I'll run quickly through this. So, based on the difference between wealth creation and wealth transfer, we have our own scheme, which is an alternative to the CCS. So, removing 1 ton of CO2 from the atmosphere is the same as preventing 1 ton of emissions entering the atmosphere. And so, instead of spending 22 billion on CCS in the UK, you could build a solar or wind farm somewhere like India, where they're building loads of coal-fired power stations, and you'd create an economically useful asset. You'd get dividends and returns, and it would be vastly more energy efficient, and you'd earn an economic return. What's not to love? So, this is the fundamental problem. The UK, these are carbon dioxide emissions. The UK is here. Total world emissions, enormous. China, India, UK, less than 1%.
So, would it not be easier? I completely agree, Keith. Would it not be easier just to take the flue gases and put them in a pipeline without going through the carbon recovery stuff first? Wouldn't that be a lot easier? Just dump like the entirety of the flue gases into the.
I don't think, yeah, there's too much though. I don't think you can do that because
what else is in a flue gas apart from carbon dioxide then?
Well, oxygen is only about 18% of the atmosphere, and therefore
a lot of nitrogen. Then.
You got a hell of a lot of nitrogen.
Yeah. Okay, you don't want to put that. Fair enough.
So the rest of the world continues to build coal-fired power stations. Here you go. Total operating capacity of coal-fired power stations still rising. Although, to be fair, the pace of new additions has been slowing. And it's all mainly in the BRICS. Look at India, still building new coal-fired power stations.
I mean, I'll say this net zero drive, all in favour of removing fossil fuels from the energy chain, but this net zero drive that we're all on, it's putting the cart before the horse.
Yeah,
I worry that actually people really haven't thought through the consequences of it all, and what the overall global impact is on the environment. And it's so easy to come out and say we're going to do this by a date, but it's so dangerous. Well,
I think you should protest by sitting in a road, Richard, with
I could glue myself to one, couldn't I?
Yeah, exactly.
Which would you suggest? Maybe the centre lane of the M4.
Yeah. Common sense in energy policy. Anyway, so how much CO2 does a coal-fired power station produce? Answer: a 1 gigawatt coal-fired power station produces about 6.3 million tons of CO2 a year. Okay. So, how much does it cost to build a 10 megawatt solar plant in India? Answer: 8.5 million quid. Yeah, so to replace a 1 gigawatt coal-fired power station with a 2 gigawatt solar farm in India would cost you about 1.3 billion. Yeah. And you get an amazing return on it. A 2 gigawatt solar power station in India would have revenues of about 790 million, and it would cost you 1.3 billion.
Let's call it a payback of 2 years.
So CCS
Fantastic.
CCS is not a solution to anything. The cost of 22 billion in infrastructure plus ongoing running costs, the UK would capture about 0.1%, less than that, of global CO2 emissions, and that's if the technology works. Don't. Far better to invest in a productive asset using UK taxpayer money that we'd get a return on, and would prevent much more emissions into the atmosphere by building a solar plant or wind park anywhere in the world. And also, thank you to Dan Leeds for sending this. We currently are paying wind farms $1 billion a year to turn themselves off when they produce too much electricity, because we can't use the electricity because we have failed to invest in the grid. Yeah. Invest in the grid instead of doing this nonsense CCS. Just increase the electricity grid so we can use all the wind power that we currently do. So I rant over, Richard.
Was it my turn to rant? No, I've had my go. I completely agree, Keith. I mean, our energy policy has been moronic for many decades, and I suspect it's becoming more moronic.
Meanwhile, this is UK oil and gas production. We're not producing any, so we're all importing it. Marvellous.
Oh, yes. Ooh. Keith.
Merry Christmas, everyone.
Yeah. I watched a little bit of a documentary. Well, it was about the winter of 1947. It's on Netflix. It was on BBC. It was on some TV program. It was quite interesting. It was about an hour and a half long, and I watched 5 minutes of it. You get the gist. But basically, the gist is that, of course, in 1947, which was the coldest winter on record, and the whole country was coal powered, and they couldn't move coal, so they started to have rolling blackouts and so forth, because the country was entirely dependent on coal.
Wow.
Right, a bit of an eye-opener, because you forget these things.
Yeah. An aside, David Turver of Eigenvalues, who specializes in the UK electricity system, has examined the list of government subsidies for energy, and he estimates there are 144 active schemes related to net zero or energy, with a total budget of 328 billion. And that means if they all go through, your energy bills will keep on rising because they're all paid for through your energy bill. The UK has the highest electricity costs in the world. It's only going to get worse, I'm afraid.
And combined with the national insurance changes, the costs to industry continue to rise.
Precisely. On to UK young people, Richard.
Thank you, Keith. So young people are getting married later and having fewer children than previous generations. So fertility rates and marriage rates are dropping.
Well, I thought the chart on the right was absolutely amazing.
Yeah.
So back in 1990, when I was just exiting university, over 75% of young men under the age of 24 were married. So I remember, at sixth form, my best friend came from a small village in Cornwall. And when we graduated from sixth form, he took a year off and spent it in his village in Cornwall. And then he came up to Oxford, married. And he had been the last person in the village to get married at the age of 18.
Gosh.
19. And now, nobody does that. There's been a huge cultural shift.
Yeah. And so the birth rate in England and Wales has dropped to its lowest value since we started recording it in 1938. It's now 1.44, which of course is below the replacement level, which is just over 2, given modern medical technology. It's not just that that women are having children later. Fertility rates have dropped across all age groups. People are having fewer children.
Yeah, even at the over 40s, which was the one that was rising, that's also started to fall.
Yeah. Young people can't afford, and this is, I think, it's a completely genuine point. They can't afford to have children.
Yeah.
And my parents' generation, typically, and this is true of my parents. My father went out to work, and my mother stayed at home and looked after the family.
Yeah.
And I think that is a model that is very difficult to afford these days, because so the structure, the financial structure of society has shifted such that you need two salaries,
Mm. Yeah.
not one. And this is all part of my argument of how financialization of the economy has distorted the way people are able to manage their families.
Yeah, absolutely. And when I was looking through cost of rentals in London, I mean, I just could not understand how the economy works because, in order to live in London in a one bed studio flat,
Yeah.
you're talking about one 1,600 to 2 grand a month in, relatively the suburban areas of London, not the centre. How can people afford that?
And one of the major problems, of course, as we've discussed, is that young people can't have children because they're spending such a huge portion of their income on rent. And clearly, also, if you have a child, then you need more space. And it's a huge disincentive to have a family if you're spending
Mm,
such a vast amount of money on rent.
absolutely. And we were talking earlier about how fewer young people are getting married. Well, they're spending half their money on rent.
Yeah.
You know,
This is just a series of charts that show different areas of the country where it's most expensive to privately rent a property, and it is London is most expensive. There's a significant upward trend everywhere, and landlord margins are being squeezed by higher interest rates, of course, and also tax reliefs have
yeah,
significantly changed. So the fundamental profitability after tax of letting a property is reduced as well. We can't save for deposit, and obviously there are insufficient properties in the country for the number of people who live here. So
precisely.
Rents in the UK rose by 9% nearly in the year to October, 10% in London.
Well, the average rent in London is now £2,200 a month.
Yeah.
Shocking.
And of course, rent has to be paid out of after-tax income. So rent is a function of house prices, as you would expect. And despite higher interest rates, house prices in the UK generally have continued to rise. There's been a bit of a pause and a shock, but basically the upward trend has not stopped. And the rental price is a bit like a smoothed house price trend, isn't it? Real earnings for young people only just recovered from their pre-GFC levels, yet rents are significantly higher than GFC levels.
Yeah, I was amazed by this chart because we know that there's been a huge increase in the minimum wage.
Yeah.
But despite that, that's shocking. Oh, I thought this was really amazing and terrible for young people.
And the rates of mental illness in young people have surged, particularly in women.
Yeah. No, it's young people are very financially stressed, I think.
And actually, of course, you see where that the inflection point is in both of those graphs. It's actually the COVID lockdowns,
Yeah.
which were totally disastrous. So higher interest rates are very bad for young people because they're debtors. They either pay through their rent or they pay through their mortgages, and young people can't afford to have families. And we are screwing, as a nation, we are screwing the young generation.
Well, we talked previously about how South Korea as a country is failing because its replacement ratio is now below 1.1 and basically the country is dying. Well, if young people can't afford to have children, which they can't, not in London, unless you're in an incredibly well-paid job, then the UK is failing as well, frankly.
Yeah.
1.44, that's terrible.
And we're heading that way, aren't we?
Okay, and quickly onto the Inflation Reduction Act, which you will remember was Biden's terribly misnamed fiscal stimulus bill, which pumped money into clean energy and which Donald Trump is threatening to repeal. Now, what will be the effect if he repeals it? Well, in Q3, investment in clean energy and renewables was 71 billion, up 12% year on year. Since the Inflation Reduction Act was passed in August 2022, investment in clean energy has doubled. The IRA included about 370 billion of federal incentives to turbocharge the energy transition. And the Republicans have tried 54 times to repeal it. Now, when Trump gets in, he's going to terminate it, he says. So this is investment in clean energy in the US, and you can see that it has surged in the last couple of years. Bloomberg estimates that the repeal of the act would reduce renewable investment by only around 17%, with the offshore wind sector hardest hit. And actually, the Republican states, so Texas, Georgia, and Tennessee, have been the biggest beneficiaries of IRA investment. Around 78% of our investments have gone to Republicans. So Trump actually might face a bit of Republican resistance in trying to get rid of it. So a full repeal of the IRA is unlikely. On the August the 18th, Republican senators sent a letter to the Republican House Speaker, Mike Johnson, urging him to preserve the tax credits. And during the last Trump administration, and he's, obviously pro-fossil fuels and anti-renewables, solar installations rose by 32%, wind by 69%. Bottom line is, renewables are price effective in the US, and so they're likely to continue to rise during the second Trump term. So whether he gets rid of the IRA or not, the renewables are likely to increase. But so IRA is probably unnecessary long term. On to Inflation Watch, Richard.
Thanks, Keith. So only one new number this time, 2.3%, CPI 2.3% in the EU for November, which is up, but core CPI was unchanged at 2.7%.
Yeah, looking at this, core CPI in the UK and the US is just too high.
Particularly in
down. Yeah.
Oh, sorry, yes. Ignore that, Keith. Yeah. So PMI suggests that global inflationary pressure is going to continue to ease. There's a correlation there, quite a strong correlation. And freight costs currently rising again. Not sure if there's any particular reason for that.
Well, presumably it's Christmas, but earlier in the year, we were talking about how freight costs are rising rapidly due to the closure of the Suez Canal. Well, they came down again.
Yeah. And so we still seem to have disinflation, and we're waiting to see what Donald Trump does regarding tariffs on US import and what effect that might have on the US and other countries' inflation rates. So with Recession Watch, we have interest rate on credit cards is now at an all-time high. And of course, one of the reasons that banks charge high interest rates is when they know the default rate is high. Delinquency rate on commercial mortgage-backed securities is at almost at an all-time high, above 10%. And that line is very sharply upwards. So it's showing no signs of slowing yet.
Yeah, this is just office CMBS, but still bad and rising very quickly.
Yeah, to which the banks are highly exposed. Credit card balance growth is slowing. Restaurant bankruptcies 2024 was pretty high, actually. I mean, as high as they were during COVID, and we know why they went bankrupt during COVID. So a lot of restaurant bankruptcies, suggesting disposable income is under pressure. Global macroeconomic data has started to weaken, driven partly by poor US new home sales, weak Eurozone PMIs, but generally there's been quite a lot of negative news around, I think, hasn't there, Keith?
Yeah, I was very surprised by this. I don't think the global peer data was that bad, but
Mm,
that's quite a really sharp
it is.
swing from
Yeah.
positive to negative, and which says something about, either it says something about the reliability of this measure and its volatility, or about the world economy.
Yeah. So permanent layoffs, as we've discussed, are rising, but the US unemployment by one measure is not a problem, by another measure is a bit of a problem.
Well, it's that the layoff rate's very low, but if you're out of a job, you're in trouble
Yeah.
because it's difficult to get a new one.
So Ernie Tedeschi's model of US growth has it slowing but not in recession.
Yeah, I thought this was interesting. Growth slowing,
Yeah.
which does chime with the labour market, but not with the GDP now, etc., etc.
Yeah. And the employment to population ratio is falling in a manner that could be consistent with an upcoming recession. It's not a very big fall yet, is it?
No, but that's generally what
Yeah.
happens just before recession. And we've been saying this for so long now that, broken record time.
Exactly. And prime age employment has begun to fall, begun to roll over,
Yeah.
which again could be a pre-recessionary indicator.
Mm,
Probability that will be a recession in the coming year. However, and how is this calculated? One wonders.
no idea.
Is falling according to Haver Analytics, DataStream, WorldScope, Bloomberg, Goldman Sachs, Global Investment Research.
Yeah. Nobody believes in recession anymore.
Yeah. So, we've got poor US households we know continuing to struggle, little danger of a US recession. Currently, jobs market may be softening. Where the US goes, the rest of the world goes. Where is Europe going? I suspect
Yeah.
Europe's heading into a recession.
Going nowhere.
Yeah.
Yeah. And we'll quickly talk about France. So, France is running a budget deficit of 6.1%. And where it's meant to be being fined by the EU. It's in political turmoil. What's going to happen?
Yeah. I think the EU is in quite a dangerous place at the moment, isn't it? I mean, Germany the German economy is in a really dangerous place. France is not great. Italy is doing better,
Mm.
and there's
On
a
a
lot of
low base.
yeah. And as things get more fraught, the EU will start to infight more
Yeah.
because vested interests become more important.
Yep. Watch this space.
Yeah.
Onto other charts. Now, thank you for sending me this. So this is the performance of various asset markets before and after the peaking of the bubble. And so when you look at the red line is if the S&P 500 is in a bubble here, and compared to other asset markets over time, the size of the bubble is tiny, but when they burst, it's super bad for a long time. Briefly about Argentina, because you'll know that Elon Musk and Donald Trump are big supporters of the new Argentinian president, Milei, and he has succeeded in getting inflation down, although it is still running at the best part of 200% a year and 2.7% a month. But that's well down from when he joined, when he became president. He has slashed federal spending by 32%, cut the number of ministries from 18 to 8, reduced energy and transport subsidies, and frozen public works projects. The Argentina has run the first government surplus since 2008.
So basically, Keith, he stopped printing money.
Yeah. Inflation's come down very quickly. Now, obviously, all the trade unions are deeply unhappy, but he seems to have things got so bad in Argentina, they had the political mandate to do it.
Money printing is the root of so many economic evils.
I agree. Now, this is US construction spending on data centers going through the roof, still rising, supporting the US economy. And I just thought this was amusing. So the light blue bars are how much it costs to create a Lady Dior handbag, and the blue bars are how much you spend on it. It's just daft. Yeah. And on to good news. Well, I thought this was very good news. So this is monthly drug overdose deaths in the US, and they have come down quite sharply. So previously, relentlessly rising trend, suddenly fentanyl deaths have dropped. Now, the New York Times is attributing it to changing fashions among drug users and falling overall drug use amongst the young. But anyway, that's fantastic news. And on to equities, Richard.
So looking down the weekly change column, the FTSE World was up 2.3% and 20% for the year. The big moves, the Nasdaq was up 4.5% for the week, 32% for the year, and the Hang Seng 3% and 16% for the year. We got Bitcoin in there at 132% increase for the year. Other big moves, the dollar index is sort of bouncing around a bit, up 4.7 for the year, but down 1.3% for the week. It's quite a big movement on the week. And the VIX was down 16% on the week. It's been a fortnight, really, but only a movement of 2.8% on the year. But as we know, the VIX moves suddenly and sharply.
Yeah, but still, I mean, that level on the VIX is tiny. Very, very confident.
Yeah. So there we have the All World Index.
Yeah, keeps on rising.
The All Share Index.
Which doesn't, frankly.
The Euro Stoxx 600, which looks a bit like the All Share.
Yeah, but again, it's had a good year despite the Eurozone economy being very weak and interest rates having risen.
Yeah. The S&P 500, which is up nearly 28% for the year.
Amazing.
The Nasdaq, 32% for the year.
Yep, no sign of slowing.
Russell 2000, 19% for the year. Most of that, a big chunk of that from about the summer.
Yeah, particularly after Trump got elected.
Yeah. The Hang Seng, the topics, Bitcoin, and the pound, pretty much unchanged on the year. Pound against dollar even. The euro against the dollar is down 4.6% on the year. And I think be interested to see whether the euro continues to weaken in line with that trade-weighted index problem.
Yeah, well, frankly, yes, I'd expect it to, because I think disinflation continues in the Eurozone. I think their inflation is going to collapse in the Eurozone. And I think they're going to have to, the economy's weak. They need to cut rates.
The dollar index is looking reasonably strong at the moment. Unusually volatile, I think. VIX, I mean, we had a big movement in the VIX, but you can hardly see it on the chart.
Yeah.
As we've discussed previously and earlier today, when speculative bubbles burst in equity markets, they tend to trade sideways for many years.
Yeah.
So we shall see. Previous bull markets have lasted a long time and risen a lot further than the current one. So this is suggesting that it's possibly got a way to go.
Yeah, absolutely. You never know.
No, and Nvidia's revenues are continuing to grow. I think there's competition coming in, isn't there? Because companies are producing their own specifically designed AI chips. Google have.
Yeah.
Apple are.
Yeah, I agree. And also, I've been reading how everyone's building these enormous data centers like Elon Musk, but actually the improvement in the models is really, really declines.
Yeah.
The marginal improvement is levels off.
Yeah. This is a chart of Nvidia's quarterly revenue growth rate. And it is still growing at a massive rate, but much slower than it was a few quarters ago. And it's been driven by this enormous increase in big tech capex, who are building out these AI centers using NVIDIA chips.
Absolutely.
the GPUs. The euphoriometer is looking very positive, nowhere near bubble territory.
Yeah, absolutely. But we keep on saying it's just stretched, and then it gets more stretched.
Yeah. And US speculative option volume is pretty high. I mean, the option it's pretty high. It's not as high as it was in 2021.
Yeah. Well, for good reason, I'd say, frankly, then.
Yeah.
Good reason then. I thought this was interesting.
Trading volumes, actually, they've collapsed, haven't they?
Yeah. Yeah.
So Wall Street analysts are forecasting another 20% year for the S&P 500. And why wouldn't you?
Yeah, exactly. Why wouldn't you?
And everybody is max long.
Thanks to Jaw It for sending that.
Yeah. And the US market is now 75% of total world equity market cap. But part of the reason for that is the US has all of the world's largest companies.
Yeah.
And cyclically adjusted PE ratios are high, but not as high as they were in 2000.
Yeah, but they're double that of Europe.
Yeah. Yeah, they are. And US earnings growth has been much stronger.
Yes. So there is a reason for that.
Yeah. So 2025 financial year earnings expectations are looking stretched, but they're looking consistent in the sense that they are higher than last year, and actuals have been higher than last year fairly steadily since 2010, with a few down years. And this is the equity risk premium chart, which is looking pretty low.
Yeah.
Cash is now yielding more than US equities, which only happened 8 times since the 1950s.
Yeah, and it always mean reverts.
Yeah.
That could mean, interest rates come down, or it could mean the
Stock
earnings yield on the stock market rises.
Yeah. The US has got this high valuation but high EPS growth. So basically, as long as it can maintain its EPS growth,
yeah,
it's probably fairly safe.
Yeah, that's right. So this is the performance of equities over bonds, and it's reached, the high end of its historic range, he says. 2 standard deviations.
Yeah.
Equities should then fall relative to bonds, he says, in my dreams.
Seasonality suggests that the market will rise in December, because it usually does.
Yeah.
European equities have been very poor investment over the last 17 years. Doesn't necessarily mean that next year is the one.
Yeah. I just don't see how it can be unless the European economy picks up.
So MicroStrategy has bought further 55,000 bitcoins for 5.4 billion. And now it's 286,000 Bitcoin. And this is the MicroStrategy price chart, which has benefited very well from the recent run up in Bitcoin.
Yeah, it has. Amazing.
Michael Saylor. And Bitcoin has been amazingly resilient to the Mt. Gox crash, China ban, the ICE, the initial coin offering crash, the pandemic crash, the FTX crash. And
yeah. Well, obviously, I think it's totally worthless. It's just a speculative asset, So, it's continued to the length of time it has failed to crash. I think it will crash eventually, he says, continues to surprise me. And on to commodities. So, quick summary: energy weak, industrial metals generally slightly positive, but mixed. Precious metals weak. So, first of all, energy. Well, OPEC are still planning to open the taps, and the market is still concerned about future balance. They think that the oil market will be in surplus next year, and oil prices fell 5% over the last couple of weeks and down around 6 or 7% on the year. Natural gas prices in Europe have risen strongly over the past 3 months and are up 40-odd% on the year. Not good for your energy bills. In the US, it seems that the natural gas surplus of the last few years is coming to an end, and gas prices have been rising. Coal falling, uranium falling. Brent towards its lows for the year, down 5% in the last couple of weeks. WTI, the same. Numbers specific to the oil market. Well, we're still having inventory draws in the US, and they have been refilling the SPR. Crude oil production actually has surged by 300,000 barrels over the last 2 weeks to a high for the year, and US production up 200,000 barrels on the year, continuing to grow despite low oil prices. Baker Hughes rig count up 3. So this is US oil production at a new high, although growth is forecast to slow. And this is the Kansas City Fed's survey of the oil price that would be needed for US shale drillers to boost production. And you're talking about $90. So US shale drillers unlikely to be boosting production much at these levels. This is European natural gas prices very high. So well up on the year. And traders are worried about summer gas supplies because of the potential end to the gas transport deal between Russia and Ukraine. So they are paying up for future gas next summer. And this is European gas storage levels. They're high, but they are falling quickly. They're falling at their highest rate since 2016 due to the cold snap. So hence, traders are worried about refilling the gas storage levels by next summer. This is UK, similar pattern to the EU, down on the past couple of weeks, but still very high. US natural gas futures, well, they seem to have bottomed. And US dry gas production has been falling. You see the peak this year is much lower than in previous years because of low prices. If prices rise again, then maybe they'll open the taps and do some more drilling. This is exports, though. Exports rising. Coal falling again. Uranium falling again, sadly. On to industrial metals. Richard.
Okay, so aluminium down a little bit on the week. If you look at the year-to-date changes, basically most industrial metals, the metals that we list, have fallen.
Yeah.
The bigger move, actually, aluminium year-to-date is up 9%, cobalt down 16%, copper's up 7.2%, chromium down 6%, iron ore down 27%. A lot of that, I think, is to do with the Chinese property crash, isn't it, Keith?
Yeah.
Lithium carbonate had a very bad year last year, down another 20% this year, down 3% last week. Neodymium down 8% for the year, although it's required in these rare earth metal magnets that go into wind farms.
Yeah.
Nickel, not very much movement on the year, really. Tin up 13% on the year. And zinc was up 16% on the year, 4% last week for reasons we do not know. Aluminium.
It's been pretty flat for 3 months, actually.
Yeah. Cobalt, which is one of these charts. Copper.
Yeah. Not really. Yeah, up on the year, but not going anywhere fast.
No. Chromium. Iron ore. Lithium.
Fading again.
Yep. Neodymium. Nickel. Tin.
Yeah, so when you look at these charts, they are up a bit over the last couple of weeks, but really, the trend over the last 6 months has been down.
Yeah. Zinc. Moving on to precious metals. So again, so gold down 2.5% for the week, but up nearly 30% year to date. Silver unchanged on the week and up nearly 30% year to date. Platinum down 2.3% on the week, but 3% on the year to date. Rhodium pretty much unchanged on the week, up 3% on the year. And palladium moving decisively in the other direction, 4.6% down on the week and 20% down on the year. So the non-gold and silver, the non-gold precious metals have not followed gold at all. So there's the price of gold.
Yep, bull market still intact.
Mm-hmm. Silver, platinum,
going nowhere.
Rhodium,
going nowhere.
And palladium. I think the problem with those three, the platinum, palladium, rhodium, is that their utility in catalytic converters, or they're using, the number of catalytic converters is going to fall, isn't it? So demand has to be falling.
Yeah. Okay, on to rates. Terrible. So this is the UK yield curve is the black line, and it's shifted up over the last year despite inflation coming down, thanks in part to the Labour government mandating stagflation. But terrible for me. 30-year rates at 4.8% so basically monetary policy currently UK interest rates 4.75%. The 30-year locks in restrictive interest rates for 30 years. I just don't think that's sustainable. It's silly. This is the US yield curve, and that's much better, but still very high. Talking about 30-year rates at 4.4%. But mind you, the US runs an absolutely enormous fiscal deficit currently. UK 2-year down a bit from recent highs. 10-year, same. 30-year, the same. But still very high. In contrast, the US 10-year has moved down decisively from its recent peak and well below its peak earlier in the year. German 10-year, that's dropped a lot over the last 6 months. Even France, political turmoil, UK fiscal deficit well above that of the UK. Yields coming down. Concluding comments. Well, the everything bubble is accelerating into year end, as evidenced by all the crypto stuff. Around the world, we've got extraordinary political turmoil. Syria, South Korea, France. And we await the presidency of Donald Trump. Next year is going to be exciting.
I also think Ukraine is going to come to a head in some way, and I think it's quite unclear how that's going to play out.
Yeah, agreed. So what have you been up to, Richard?
Nothing.
Good for you.
Yes. How about you, Keith?
Well, I'm afraid I have had to be very busy. So my bond trade has been a total disaster this year, as you all know. But that Chris Giles piece made me realize it could get one hell of a lot worse. So I had to react. And so I bought T61. This is the 2061 gilt. So retaining duration, but switching into the conventional. You'll see T61 well up from its lows. This is a very tax efficient bond. It's the most tax efficient one. So you get 4.3%, not 4.8%, but that is equivalent to 6.5% if you're a 40% taxpayer. And I sold T68, which, note, it's hit new lows. So I think the market is starting to price in that change to CPIH after the Chris Giles piece in the FT. So it's still heading lower. So thank God I did that. That is super depressing, frankly, because yields on the conventional are falling. Yields on the but the price of the index-linked gilt is falling. Okay, so that was actually incredibly depressing, having to crystallize absolutely enormous losses. But the danger when you have huge losses like I do is you get trapped in front of the headlights and you fail to react. And actually, I felt positive about doing that and actually still, rather than just not wishing to crystallize those losses, just doing it. Now, elsewhere. So this is my gold recovery investment, Goldplat, with operations in Ghana and South Africa. Share price jumped slightly last week, well, about 20%, on the back of an RNS saying that they will beat expectations. So they're talking about 6 million pre-tax profits, which I estimate is about 4.4 million post-tax. After the recent rise in the share price, the market cap is 13.5 million, of which cash is 3.1. So it's on a P ratio of 3, or just over 2 excluding cash, like dirt cheap. What it needs to do is to use some of that cash to either instigate a dividend or some share buybacks that would send the share price through the roof. It's also, and the big value of this company is that the tailing storage facility has gold in it worth 243 million by my calculation. Market cap of this company, 13.5 million, excluding cash, just over 10. If it can get the permits to start reprocessing the gold in the TSF, then there is a lot of value there. So it's been a bit of an indifferent investment, frankly, but the catalysts are still in the future. And the other thing I want to talk about was, I bought REITs, and they've been, again, like everything I've touched this year, they've been terrible because bond yields rose, therefore the value discount rate on the assets of these REITs has risen, which means their NAV's fallen, and they've all generally down. So even buying income has been disaster for me. And this is the SDCL Energy Efficiency Income Trust. And I bought it about here. It promptly dropped by 20%, at which I doubled my position. The shares were then at a discount of 50% to NAV and yielding 12%. And it's had a nice bounce back. I have got back to flat, frankly. It invests in energy efficiency projects for industrial companies. So here it's just LED lighting, etc., on long-term contracts. So the dividend is covered fully by cash flow. Take a look. Anyway, that's it. Merry Christmas. We will get one more out over the Christmas period, which will allow me to hide from the relatives for a few hours. So watch this space. It probably won't be in Monday in 2 weeks' time. It'll be when Richard and I are available, and when we're fed up with turkey and sprouts. So
never.
So Merry Christmas.
Happy Christmas, everyone.
I hope you've had a better year than me. My year's been absolutely appalling. Anyway, we carry on. So in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, We make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.